Welcome back, everyone. I'm pleased to introduce Ben Carlson from Ritholtz Wealth Management as our next presenter. He is going to talk about a tool for market volatility, that little thing called diversification we've been talking about all morning. At the end of his presentation, he's going to take questions from you live. So be sure you enter your questions on the right-hand side in the chat box on YouTube, and we're going to get to them as many as we can at the end of his presentation. So without further ado, Ben, I'll pass it off to you.
Thank you. Thanks everyone for being here. So I'm going to talk about diversification today, just from a number of perspectives, mostly from an investment perspective, but just wanted to give some quick overview for those of you who aren't really familiar with the concept. There was a great investment thinker named Peter Bernstein who once said, diversification is the only rational deployment of our ignorance. And basically the idea here is that, no one knows what's going to happen. So you figure out a way to spread your bets just as a way to manage risk. So I'm sure like many of you, I have been binge watching TV lately. There hasn't been much to do the last few months. People are finally getting out and about, but one of the classic shows that everyone has in their top 5, top 10, unless you're a really big contrarian, is The Wire. If you're not familiar with The Wire, the guy pictured here was the character Stringer Bell. So he was the business mastermind behind the Barksdale crime organization. And he deployed diversification in the drug trade in The Wire. And how he did this was they had to make sure that the police couldn't track them because the police were trying to track their phones. They were trying to figure out what they were doing. And the way that he did this was he had all of his drug dealers use burner phones. And it was not just burner phones because eventually the cops could track those, but they made sure that they bought burner phones at different locations. So if the cops went to one store to see if they remembered a certain person buying a phone, they couldn't. So they had these multiple burner phones, and then they also used multiple SIM cards. And that was the way that they used diversification to manage risk in this crime organization. Not technically the way you want to use it in your portfolio, but that's just one way that they did it. And it's kind of funny because something that ended up bringing down him and his Barksdale crime organization was they didn't diversify where they rented their cars from. So one of the people in the organization rented their car from the same place every time. And that's one of the ways that the cops actually took them down. So they kind of had diversification that worked against them because they didn't use it fully. Now, of course, today I'm talking about your investments and that, diversification kind of as a concept really extends beyond that. So we can have diversification of opportunity if you're looking for a job. You could have diversification of income as a way to really, diversify your income stream. So you can also have diversification of ideas and opinions. But today I'm just going to look at it from an investment perspective. And I think before we get into the concept of diversification, it makes sense to understand, why are you investing in the first place? So what are you putting your money to work for? Why don't you just hide it under your mattress and keep it safer under there? And really the idea here is that you're protecting your purchasing power. So one of your biggest risks that you're diversifying away from is inflation. So this is the price of goods over the past 40 years or so. You can see a movie ticket has more than doubled. The cost of college admissions obviously has gone up, more than triple. The price of a house, is up almost 4 times. So if you just bury your money under the mattress and do nothing with it and you don't invest, even if you're saving, it really doesn't help you much because your money is not working for you and it's actually technically losing money because it's going under. And so if we look at this chart for how long it takes inflation to cut your money in half, you can see even a small 2% inflation, which is basically what the inflation rate has been running at for this century since the year 2000. In 35 years, your money is cut in half. So if you just do nothing with your money and don't invest it, that's actually a huge risk, even if you're saving, because those dollars will be worth less. So if you think you have a certain number in mind, you say you want $500,000 or $1 million or whatever it is for retirement, that number today is not going to be the same thing in the future if we have any meaningful inflation. And this is one way that compound interest kind of works in reverse. So if you have a credit card and you're paying 15% interest on that credit card, in a little under 5 years, you're going to have double the amount that you owe if you pay nothing on that card. So this is how inflation and interest rates work in reverse for you. And it's almost this like reverse compound interest. And that's why I always say, the number one rule in personal finance is, don't carry credit card debt. So we figured out, why you invest. You want to beat the rate of inflation. So if you want to beat the rate of inflation, what is your best bet? If you look long term, the 3 main asset classes: stocks, bonds, and cash. And when I talk about cash here, I'm not talking about burying money under your mattress. I'm talking about short-term government vehicles or even like a savings account. And so you can see this is the long term over the last 90 plus years since the late 1920s. The stock market has, pretty much doubled up the bond market. For those who aren't familiar, bonds are just a simple form of letting someone else borrow money from you or loaning to them. So that could be loaning money to a government, a corporation, mortgages, car loans, anything. And you can see these are the long-term returns. These aren't promised to anyone. Now you can see this is, a 92-year period. So take it for what it's worth. No one actually has, not many people I know have a 92-year time horizon to invest. But you can see the stock market has little less than doubled up the bond market. But if you look at the growth of $1,000, the stock market exponential growth has been much higher. And that's how compound interest works, in that you get this money building on top of money, building on top of money. And again, I remember, think of a cash as like your savings account. So over the long term, you've gotten a little over 3% in just keeping your money in something like the Ally Online Savings Account, I guess, which is where you want to park your more safe accounts. And if we think about these numbers, these are nominal numbers, meaning they don't take inflation into account. You can see how inflation takes a cut of even these numbers. So this is over the long haul, the last 90 plus years, inflation has run at about 3%. Again, it's been a little lower lately, but you can see how much that takes it down just in terms of your growth, in terms of what that does to your money. Now, again, stocks are still one of your best bets. Now, if you look at something like cash, over the very long term, inflation eats up most of that, where it basically just gets you a little bit of money and doesn't earn you much. Bonds still have earned a little bit of a premium, but those rates are much lower now than they have been in the past. So that's kind of the way it works. That the stock market over the long haul is your best bet for growing your money over the rate of inflation. Now, so again, this is one of the reasons that inflation is this sworn enemy over the long haul. So the question is, why do stocks earn higher returns than bonds or cash? Well, one of the reasons is they're just riskier. So this looks at the annual returns of the stock market since 1928, and the green shows the highest return, the red shows the lowest return, and then the blue in the middle is the average that we looked at it before. So you can see you could drive a truck through the range in stocks. So the highest return ever has been 53%. The lowest return ever was 44% loss, and this is just for a single year. The gains and losses have been bigger in other longer periods. Now you go to bonds and you get a little bit of a narrow range. Bonds have had pretty good years in the past too, when they've had higher interest rates or falling interest rates, and the losses are a little lower. Now you look at cash and you see that cash, for the loss, it has never been negative. And so it's never had a down year. It has had a decent up year or two in the past, in the early 80s, when interest rates were much higher. But the whole point of this is, if you learn nothing else from this talk, it should just be that risk and return are attached to the hip. So almost every country economists and stock market historians have covered over the years, stocks have had higher returns than bonds. And the reason is because they're riskier. And further, unfortunately, if you want those higher stock returns, you're going to have to pay for them by bearing some sort of risk. So that means, this is a polite way of saying, from time to time, to earn higher returns, your portfolio is going to lose a truckload of money. And obviously, this year is no different than that. We saw that those high returns, come with a risk. Now, this is a different way of looking at these annual returns. So this shows these are every year stock market returns going back to 1928 for the U.S. stock market. You can see they're kind of all over the map. There's been some very good returns, some very bad returns. One thing you should notice here is that the average long-term return for the stock market has been, in the 9 to 10% range. But the majority of the time, the stock market from any given year gives you nothing even close to that. So your experience over the short term in the stock market is very rarely what it'll be like over the very long term. And long term, I'm thinking 10, 20, 30 years, a very long time horizon. Now, if we go to bonds, you can see, much lower highs and lower lows in the stock market. You can see that's a pretty big shift, and things retch down. Then we get to cash, and you see, again, no down years, not many big up years. And I kept all these on the same scale for a reason. So if we scroll through here, you see stocks all over the place, bonds much closer together than cash. And now, depending on your tolerance for risk, some people will look at this and say, well, why wouldn't I only invest in stocks? Well, some other people would say, why wouldn't I just keep all of my money in cash in a short-term savings account and never lose money? Now we're going to go through some of the reasons for that. And one of the reasons that you don't just invest in stocks is because they're risky. And again, not everyone has a very long time horizon for their money. So if we look at these returns by decade, so we look at stocks and bonds and cash, you can see in the 1930s, the stock market was down for the entire decade. The same thing happened in the 2000s. I'm going to get to that a little later in terms of the lost decade. Now look at bonds and cash. In both of those decades where the stock market had an abysmal time and lost money over 10 years, bonds and cash actually did well for you. And so if you needed to spend that money for something, you have that. So let's say you're saving up for a down payment for your house, or you have a wedding. And let's use this March and February as an example. In 23 trading days, the stock market fell 30%, which was the fastest that's ever happened in history. So 2020 is kind of one for the record books. If you needed to spend that money, and even though stock market has earned higher returns over the long term, that really doesn't matter, because if you had to spend that money and you needed to pay for a down payment on your house and you went to do it and stocks fell by 30% in March, you're kind of out of luck, because that 30% loss just took away your whole down payment. So that's why we have these bonds and cash to diversify when things go wrong in the stock market in the short term. And you can see one of the things that the bond market has done really well is hedge out the risk of the stock market. So this is every down year in the stock market. And again, I'm using the S&P 500 here, which is just a broad-based index of the US stock market and the biggest companies. So out of the past 92 years, the stock market has been down 25 of them. So let's round it up and call it every 3 out of every 4 years, the stock market is up on average. 1 out of every 4 years, the stock market is down on average. Now, if we look what bonds have done in those times when stocks have been down in those 25 years, the bond market has actually been up every one of these times but 3. So one of them was in 1931. Bonds were down, 2 or 3%. In 1941, when stocks fell, stocks were down 2%. And then in 1969, bonds fell 5% when stocks were down 8%. So 3 times out of 25 where bonds didn't provide much diversification, even though they didn't fall near as much as the stock market. Now, this almost happened in 2018, actually. Bonds were basically flat on the year and stocks fell 4%. But you can see the average year when stocks have been down, they fall in double digits on average, and a 13.3% loss. In those years, the average return for bonds has been 5.1%. So that's your short-term hedge, and that's why you diversify in something like bonds, and that gives you, 2 things. 1, it hedges out your risk and lowers your volatility of your portfolio, depending on how much you have in bonds. And 2, it gives you some dry powder if you need to use that for spending money, or if you need to use it just to rebalance and buy more stocks in your portfolio. So bonds provide this ballast and this anchor. And so those people who can't handle having their entire portfolio of investments in stocks, you have bonds there as really this anchor to provide a little help when things are bad. And so if you have spending needs, you have a hedge. And so this is just sort of a visualization of this, where you can see the red shows every year that stocks were down. The green shows what happened to bonds in those same periods. And you can see, this is diversification in a nutshell. While bonds offer lower long-term returns, in the short term, where life is lived for a lot of people, that they provide a really nice hedge for you. So the question is, great, stocks can be great for the long term, potentially terrible for you over the short term. So what's the right way to think about diversification among these different asset classes in terms of risk? And I do like to think about it, mainly in terms of risk, because that's kind of the way that you build a portfolio, is based on your risk tolerance and your time horizon. And so, as we've all been watching a lot of TV lately, one of my wife's favorite things to watch is Shark Week on Discover. Kind of surprising that this show has actually been on for 30 years now, more than 30 years. And they've actually started to research the people who watch this show to see what some of their reactions are. And so researchers asked a huge group of people to watch the show while they study their reactions and their emotions and how they felt about sharks after watching it. And now the producers have gone to great pains over the years to show people that, yes, sharks are scary and the movies are portrayed as these nasty animals that go after people, but it's really a very low probability event that someone is actually going to get attacked by a shark and killed by each year. But what they found, even when presented with this data, the longer someone watched Shark Week, the more nervous or scared they became of sharks, regardless of what the stats were telling them in the show. So the stats would say, sharks are not that big of a risk to you, but the longer you watch, the more scared you became just because you watched them. And that's the way to think about the stock market. So if we go back to the 1920s with the stock market, if you looked at it on a daily basis, it's probably 56% of the time. It's negative the other 44%. So let's call it a coin flip. It's basically 50-50, where the stock market on any given day could be up or down, which is kind of hard to believe since over the long term the stock market is up. That just means that the daily gains really outweigh the daily losses. But anyway, if you're looking over just a single day, you're going to think this makes no sense. I'm up, I'm down, I'm up, I'm down. The losses will weigh on you so much more than the gains. Now, if we extend our time horizon a little bit, as I said, over a year, 3 out of every 4 years is up. If we extend it to 5 years, you're getting closer to like 90% of the time the stock market has been up. Over 10 years, it's roughly 95% of the time the U.S. stock market has shown gains. And if we go over 20 years, the stock market has never had a loss over 20 years. So the longer you extend your time horizon, the less scary it's going to be. Unfortunately, sometimes it's really, really hard to look away. And so, I think especially if you're young, just not looking at your retirement balance, if you're saving for something that's 10, 20, 30, maybe 40, even 50 years off into the future, it's one of these things where the fewer times you look at your balance or your statements, the better off you're probably going to be. Now, when we think about, okay, so what is a risk in terms of animals? It's kind of interesting that the deadliest animal is actually something that you've never even think of. It's a mosquito. And you can see shark way down the list in terms of, this is a illustration by Bill Gates, and he shows, this is from 2015. Mosquitoes killed 830,000 people. In 2015, shark attack was 6. And so this is kind of the way that risk works in the market as well, where the risks are kind of the stuff that you don't think about or you don't see. It's not the stuff that you really worry about. So a lot of people worry about the short-term volatility in the stock market. That's technically not your biggest risk. It's more the stuff you don't think about. So there was a guy, political scientist from Ohio State University named John Mueller, and he talked about, after 9/11, people became really scared of terrorists and what they're going to do. And if you look at the averages, Islamist terrorists have killed about 7 people a year within the United States since 9/11. Obviously, all those deaths are tragic. But over that same time frame, lightning kills 46 people a year. A deer running in the road causing an accident kills another 150. Drowning in a bathtub kills 300 people. Yet obviously Americans fear terror much more than they fear drowning in the bathtub. And so I think it's just one of those things where we have a hard time understanding probability, especially over the long term when these short-term fears crop up. And I'm sure from this pandemic, we're going to see a lot more of these other unintended consequences like that, where people are scared of things that they maybe shouldn't be. And that's just kind of the way that human nature works. So the way that to think about risk in terms of your portfolio, I like to use this example from Dr. William Bernstein, who was actually a former neurologist who decided to study investing because he didn't have a handle on his own finances, and he became a well-published author and investment thinker. And if you you're interested in learning more about him, his book, The 4 Pillars on Investing, is a classic. But he came up with this concept of deep risk versus shallow risk. And he said, risk comes in 2 flavors. Shallow risk is this loss of capital that recovers relatively quickly within several years. And then deep risk is a permanent loss of capital. And of course, shallow risk is what we had happened earlier this year. The stock market fell 35% over the course of 4 or 5 weeks. And then over the course of 7 or 8 weeks, it recovered most of that, and it was up 45%. Now, typically the stock market doesn't always recover that fast. The average bear market could take anywhere from 12 months to 36 months to recover, sometimes even longer than that. So this year has been pretty unique in terms of how fast things have been happening. But the way to think about it is shallow risk, while painful, it deprives you of sleep. It's this deep risk that is more of a permanent loss of capital. And he lists 4 main causes, and it could be something like hyperinflation or prolonged deflation or devastation, which would be like a geopolitical disaster or war or government confiscation of your assets. So the way to think about this really is, especially young investors should welcome something like shallow risk. So if you're a young investor, you have 10, 20, 30, 40 years ahead of you, shallow risk is it should be your base case, and it should be one of your best case scenarios in terms of deploying capital and savings. So if you're saving on a regular basis, you almost want to root for lower prices, because assuming you can keep your job through the hard times like we've had now, deploying your investment capital when prices are lower, that's a good thing. If stocks rise over the long term, but they fall over the short term, you're able to buy in at lower prices and higher dividend yields and lower valuations when stocks fall. I know it can be scary sometimes, but that's kind of the way to think about it. So the question is, so what is your risk? So, and the way that I like to think about this is your true risk. So, really, two questions. Are you on track to achieve your financial goals, whatever they may be? And then the question for risk is, how do you minimize that risk of not achieving your goals? So, your true risk is not something a politician does, or tax policy, or market volatility, or bear markets, or recessions, or interest rate movements. It's this idea of, people are more concerned with getting rich with their money, but the really important thing is to minimize the chances of not dying poor. And I think that's one of your true risks that a lot of people don't think about. And the way I like to think about this is through the investor life cycle. So a lot of the concept of risk really depends on where you are within your investing life cycle. And so risk means different things to different investors depending on their time horizon and risk profile. And so, when you're just first starting out, time is your biggest asset. So when you're an older investor, you probably have more financial assets. So obviously baby boomers have much more financial assets than people who are millennials or Gen Z. That's just because they've had longer to save and make money. And so they have a higher financial asset. Their biggest risk is outliving their money. So they are at the point where they don't have as much income coming in. They don't have as much time to wait out a nasty bear market, and they don't have as much savings to put in when stocks fall. So they really have to take care of their financial assets. And diversification probably becomes more important for those investors than it does for younger investors, who their biggest asset is human capital. So that's not just, people worry about their investment portfolio, but you also have to, especially as a young investor, think about your job portfolio. And that's what human capital is. It's your future earnings and how you take care of your career. And so your biggest risk as a young investor is really just not saving enough, because you have your biggest asset really is time. So, Warren Buffett is one of the richest people on the planet, depending on what time you look at the Forbes list. He's in the top 3 or 5, I guess. I'm positive he would trade a lot of that money to be younger again, because all these young investors have something he never has, and that's human capital and time. And when you have time on your hand, you can allow compound interest to do a lot of the heavy lifting for you. But that's assuming you save and invest your portfolio in a prudent manner and put it away. So, I think about this as young people should really get on their hands and knees and pray for a bear market, because if they're willing and able to save more, that's actually a good thing for you, because you get to, again, put your money to work at lower valuations, higher dividend yields, lower prices. It's funny because the stock market is one of the few places where when prices go on sale and they go down, people run out of the store, which is kind of wild. Obviously, maybe that hasn't happened as much this year because things came rushing back so quick. But, and then older investors have to be a little more thoughtful about how they diversify their assets, because they don't have as much time to ride out a brutal bear market. If it lasts, 12, 24, 36 months, they have to have some other assets that can, help them with their spending needs. So the question is, how does diversification within a portfolio actually work? Now, in theory, this is one way that portfolio diversification works. Let's see if I can get this video going. So I really like this visual. Now, there's this concept developed in the 1950s by a guy named Harry Markowitz. In 1952, he published this piece called Modern Portfolio Theory for the Journal of Finance. And I like the way that this illustration works with the pool balls here, because the way that you think about modern portfolio theory within a textbook is you have all these assets and they move in different directions at different times, and you calculate their correlations and their variances and all these crazy math terms, and you get this perfect, synthesis of a portfolio that moves in different directions. Unfortunately, the real world doesn't always work like that, where you have an asset that has characteristics that stay the same over time. And Markowitz himself, actually, it's kind of funny. He developed this theory where you use these covariances in these efficient frontiers, and that's probably a little too high level for this discussion. But it's this applied mathematics. And someone asked him one time, when you created your own portfolio, did you use this modern portfolio theory to create it? And again, this was just a theory. It wasn't something that had to be put in practice, but it really changed the way individuals, and especially larger investors like pension funds, manage their assets. Because in the past, they would have them all in safe bonds, and they didn't really have these different assets that could work differently in different environments. And so someone said, did you take this mathematical framework for assembling a portfolio of assets and figure out the way that the expected return should be for a given level of risk? And Markowitz said, I should have computed the historical covariances of the asset classes and drawn an efficient frontier. But what I actually did was I visualized my grief if the stock market went way up and I wasn't in it. And then I visualized my grief if the stock market went way down and I was completely in it. What I did is I just split my contributions 50-50 between stocks and bonds. So, the essence of portfolio construction is really just a combination of different asset classes such that they move in different directions, at least some of the time. Not all the time like this video would show, but at least some of the time. And I think that, perfect is the enemy of good a lot of times when constructing a portfolio, because a perfect portfolio, only exists in hindsight. There's no such thing as a perfect portfolio now that you can put in where things are going to move in concert like this. So this is an illustration of diversification. I like to use. This is an asset allocation quilt. This is a bunch of different asset classes. So this is large cap U.S. stocks, small U.S. stocks, mid cap U.S. stocks, real estate, emerging markets, foreign stocks, all these different asset classes. And you can see this is segregated out by year. So this is from 2005 to 2019. And the different colors showing each asset class. And what it does is ranks them by year. So the best performers on the top, worst performers on the bottom. You can see, you could try to draw an algorithm here and come up with a pattern, but there's really no rhyme or reason from year to year, and that's kind of what diversification is all about. You're really giving up the ability to hit home runs, but you're using that giving up on home runs to avoid striking out. So it's accepting good enough just so you can avoid terrible. So I'll use an example here. This blue line here, if you can't read that, that's emerging market stocks. So you can see in some of the years, 2005, 2007, 2009, it's one of the best performers. In other years, 2018, 2008, 2011, it's the worst performer. So if you had all of your money in emerging market stocks, you'd have the highest of highs and the lowest of lows. Now, some people can withstand that type of volatility. I don't know too many people who can. So if you have an extreme portfolio with no diversification, you could be all over the map. You could be the worst performer one year and the best the next, or the middle of the pack. Now, what if we take more of an asset allocation approach where this is just an equal weighted version of all the asset classes in here. So I took all these asset classes and put them together, and you can see, you miss out on the highest of highs, but you also miss out on the lowest of lows. And if you look at the total return over the course of it, you get kind of something in the middle here, and then you get it through a lower volatility. So you actually get a little bit of a less bumpy ride. So instead of having these extremes, diversification really allows you to have a less bumpy ride. It should give you a higher expected return for a given level of risk. And that's kind of the magic of diversification, that, you lower your volatility and have a less bumpy ride over time. Now, this is another way to look at it, because the problem with thinking extremes in your portfolio is that you could have a really bad decade. And so this is the lost decade from 2000 to 2009. And the reason it's called that is because, again, the S&P 500 finished with a negative return. So on a total basis, the S&P 500, which is the largest U.S. stock, it's kind of the proxy for the overall U.S. stock market, lost 9.1%. Now you can see some of these other asset classes. Foreign stocks did a little better. U.S. small cap stocks, bonds did a little better than that. Emerging markets had a really good decade then. REITs, which are real estate investment trusts, which is the way to invest in commercial real estate, and then U.S. small cap value, which is just smaller, lower valuation stocks. Those ones had a great decade. So if you were just in the S&P 500 for that decade, you felt awful. If you had a more diversified approach and you had a little bit of your portfolio in some of these other things, you did pretty well. Now let's look at the other side of this, where this is after the lost decade. So 2010 to 2019, you can see it's completely flipped. The S&P 500 went from a loss of 9.1% to now the biggest gainer at, over 250%. Some of the other winners came back down to earth, emerging markets. The problem with diversification, it's kind of one of these things, like it's the best way to invest, except it's one of the worst ways to invest, except for all the other ones, because there is no perfect strategy. So it really means always saying you're sorry, and the fact that there's always going to be something in your portfolio that you hate. So here, why would I ever invest in the S&P 500? Why would I have my money in small cap stocks? And then here it's, oh, this is great. The S&P 500 was the best. Small cap stocks came back. Some of these other ones did worse. So the problem is we just never know what is going to be the best performing asset class in a given year. So, or a given decade even. There's really no way, no rhyme or reason to pick it. So that's why we diversify, because we don't know. And this is also why looking at your portfolio in the rearview mirror to make your decisions is a terrible way to invest, because if you said here, why would I ever invest in the S&P 500? It did terrible. Then you look at what happened the next decade. People are probably saying the same thing. Why would I ever invest in emerging markets? And they forget that in this decade it did really well, but now it's done horribly. So that's one of the reasons why it's so hard to just pick the best performer. If obviously there would be no need to diversify if we could just pick the best performer every year or decade. but unfortunately, investing is not that easy. So for anyone who doesn't know, and I've yet to ever meet anyone who knows, what the best performer is going to be over a given period of time. That's why we diversify. One other way to think about diversification that I think makes sense, especially for people who are going to be net savers, is just this idea of diversifying across time. So if you're someone who, some people are lucky, they may have a big lump sum, they get it through an inheritance, or they get a bonus at work and they put it to work on whenever they get it January 1st and let it ride through the whole year. Then they get the whims of the stock market. But if you're like a normal person, you're probably saving every time you get paid. So what I did here, I did this a couple weeks ago. So these numbers are a couple weeks stale. They're probably a little higher now. But what I did is I decided to look, what happens if you get paid every Friday and you decide to put, a couple $100 of your paycheck into the stock market in the form of an ETF or something. So this is the S&P 500. And this is by week. So every Friday, you put a little bit of money into the S&P 500. And this shows what your returns would have been like this year alone, just investing on the end of the week. So you can see how wild this year has been in the stock market. So if you're investing in January and February now, you're down a little bit. If you're putting your money to work in March, which is the middle of the chart here, you're pretty happy. Stocks have gone up big. So this is one of the reasons why diversifying across time can also be helpful, because, dollar cost averaging is one of the most effective ways to manage risk of a bad outcome. And the great thing is a lot of people just have to invest this way because that's how they get paid. And so the great thing about dollar cost averaging is, you're buying fewer shares when stocks are going up, but you're buying more shares when stocks are going down and prices are going down. So it's really a way to balance out your risk of having a bad outcome by just putting it in at any one point in time. So diversifying across time with your savings is also something that can be helpful. So just before I get to some questions, I just wanted to go through, some things to think about before diversifying your portfolio. I think it's always helpful to understand why you're investing in the first place. What are your financial goals? I think that really helps you define what your time horizon is, what your risk profile is. How you invest should depend a lot on what your age is and what your goals are. Are you saving for a wedding? Are you saving for a house down payment? Maybe you want to be a little safer with those assets in cash or bonds, or are you saving for retirement and you can take a little more risk in stock? When do I need this money is a great way to think about your time horizon. Do I need to spend it within 3 to 5 years? If that's the case, the stock market is a pretty risky place. If you need to spend it in 10 plus years, the stock market has tended to give you much better outcomes for something like that. What is my willingness, ability, and need to take risk? Obviously, everyone's circumstances are different. So no two people are going to have the same exact risk profile or time horizon. And I think really figuring out the balance, and of course, sometimes it's hard to really figure out what the middle ground and equilibrium is for that willingness, ability, and need to take risk, because there are no perfect answers. Sometimes these things are competing with one another, but really understanding yourself and especially your lesser self and what some of your behavioral foibles are, and where you stand financially and where you want to be, it can be helpful. How complicated your financial life is, I think that's a big thing in terms of setting the right portfolio, and then figuring out how to focus on what you can control, because there are so many things out there that we just don't control. Like we can't control tax policy and who the politicians are and the president. Sometimes it's not always up to us individually, but there's a lot of things you can control, like how much you save, what you pay in fees, these types of things, how diversified your portfolio is. So that's what I think really helps when setting up a portfolio, is just focusing on the things you can control and trying to forget everything else. Before I get to some questions, just wanted to give, if you're not familiar with me, if you want to find me, I got a weekly podcast I do with my colleague Michael Batnick called Animal Spirits. I've written a number of books. Probably the most popular one is called The Wealth of Common Sense for individual investors. And then I have a blog by the same name called The Wealth of Common Sense that I write a few times a week on, if you want to know what my thoughts are on personal finance in the markets. And now I think we've left plenty of time for some questions, so I'm happy to answer if you have any questions for me.
Yeah, thanks, Ben. That was a really great conversation. I think dropped a lot of knowledge on our viewers, which is really great. We love that. We did get a bunch of questions, so I will just start throwing them at you. First up is John Shuk. What are your thoughts on alternative assets? Museum grade cars, collectibles, art, watches?
I do think that's an area where people are going to have the opportunity to invest in the years ahead. They're making it so you can buy fractional shares in these things. I think I would tell people to make sure they have their financial house in order in other ways before, have some retirement assets and regular assets to set aside, an emergency fund and that sort of stuff before venturing out into alternatives. I think you really want to understand what you're getting into and understand how these assets work. But I think it is interesting that this stuff is becoming democratized and easier for people to invest in. I think I would make sure that you have everything else, zipped up first, and then use some fun money for that stuff, though, I think, before really diving in deep.
Yeah, I agree. Jesse Rosenstock, Ben, earlier we talked about a 60-40 or 70-30 portfolio. What are your thoughts on applying that to a 401k, personal brokerage, and other retirement accounts? My 401k is already diversified in a 2050 target date fund.
Yeah, honestly, I think a target date fund is probably the easiest choice for people who just want to keep their life simple and not have to rebalance on their own or make any changes. I think it's one of the better retirement vehicles that we've had created in the last couple decades, because it just takes the behavior out of the equation and it does it for you. Because a lot of times, people think that their willpower will win out and they'll just do it on their own, but a lot of people just don't have the ability or the foresight to do that. And if you're having someone else do that for you and taking yourself out of the equation, I think makes a lot of sense.
Fair enough. Ronnie Nikki says, what are the pros and cons of investing in physical real estate versus REIT stocks in the REIT sector?
Yeah, I think it's much easier to become diversified in something like REITs. It's a lower cost. It's probably fewer headaches. If you're investing in actual real estate, it's much harder to get diversified unless you have a huge amount of money to put into place. I think you're taking bigger risks in real estate. There's probably bigger returns available because you have the leverage involved. But for anyone who's ever owned a house, you realize that there's a lot of ancillary costs involved, taxes and upkeep and maintenance. And so I think you just have to be ready and willing to be able to take care of those things, which, just as someone who owns a single home, that's a lot. So I think diversifying into something like a REIT is just much simpler and easier. It depends how complicated you want to make your life.
Connie says, how do we estimate times in the market to move between stocks and bonds for max long-term savings?
Yeah, I think a lot of it depends on, again, what your time horizon and when you need the money. But if we're talking about an asset allocation that you've set up, if you set up a 60-40, 70-30, 80-20, 90-10, whatever it is, then figuring out some sort of set rebalancing schedule. So that could be, you could set a band on it. If stocks move a certain percentage, you'll sell some stocks and buy some bonds. Or you could just set it automatically and say, every year on January 15th or on my birthday, whatever it is, I'm going to get back in line with those stated weights, and that's kind of a risk thing. So I think it really depends on, again, when you need to spend the money, and then if it's retirement assets, then it's figuring out a set schedule. Now, it could be every year, it could be every 6 months, it could be every 2 or 3 years, just as long as you have it periodically set up to do it all the same and make it a rules-based framework.
Yeah, makes sense to me. JS says, Ben, gold is one of the traditional inflation hedges, but could Bitcoin have any value as a portfolio hedge as a new age gold?
I think
that's a thought.
Yeah, it's certainly, I certainly put it in something of a non-correlated asset, and that it has its own characteristics. Now, of course, there's no cash flows to deal with, there's no dividends or income payments. So much like gold, you're dealing with an asset that is going to be very trend based, and it's going to be what people think about it. So it's hard to say, put all of your assets into something like that. But as a I think having part of your portfolio and something that's fun and speculative, if it's a small amount, 5 or 10% of your portfolio, if you want to have some fun, I see no problem with that.
All right, Monica M. When should a person consider giving up on diversifying by themselves and pay for an active manager? That's a great question for you.
Yeah, I think when your financial life gets complicated, or when you just don't have the time or energy to do it yourself. So a lot of people that come to us as clients, some of them just have such complicated financial planning lives that they need some help, and they need advice on taxes and estate planning and all these things. And other people come to us because they just have more important things to do with their life, and they just don't want to do it themselves. And they say, you know what, I'm just going to outsource this. My time is more valuable doing other stuff, and I just don't really care about it. So it really depends on how complicated your life is and your finances are, and then how much you really just don't want to have this on your plate.
Yeah, for sure. All right, Andrew Cam, what are the pros and cons for investing in an ETF versus a mutual fund, and are there options for both that follow the S&P 500?
Yeah, and that's probably one of the most widely tracked indexes you could find. I'm sure you can find, and you can get it for pennies on the dollar in terms of cost. ETFs allow you to trade during the day. So if you wanted to trade at any specific time between 9:30 and 4 p.m. Eastern, you can trade an ETF. Mutual funds, you can only buy or sell at the end of the day, and they give you the net asset value at the end of the day. Over the long term, it's kind of a wash. ETFs probably have a little bit of a lower cost than mutual funds, even though the mutual fund costs are coming down. But if you found a mutual fund or an ETF that tracks the S&P 500, it's going to give you a pretty similar return, less the cost. So the biggest probably con with an ETF is that because you have the ability to trade during the day, it might be more tempting to do so. And so you could eat up any gains with, a bad buy or sell, whereas a mutual fund, you can't be trading as much.
Right. Okay, next up, Alan, with U.S. government bond yields low on a nominal basis, does it make more sense in this environment to select U.S. bonds, or in this environment, if selecting U.S. bonds, to consider TIPS, which is inflation protected U.S. bonds?
Yeah, I certainly think diversifying within your bond portfolio makes more sense now than it ever has in the past, because in the past you could earn much higher returns on your bond portfolio and not have to worry about it. You could actually do the old thing where you live off the interest on the beach, and now that's just not the case anymore. So as I said, inflation is one of the risks that could rear its ugly head at some point. It hasn't been around for a while, but investing in TIPS is probably one of the most unique assets there is, because it effectively gives you a one-for-one hedge with inflation. So if inflation goes up, your bond is going to go up as well. So I think it is one of the more unique real assets out there that's different from a lot of other bonds.
Yep. Eric, I'm not going to say his last name because I'll butcher it. How do you think the market will be impacted if the Fed took rates negative?
They said they're not going to. I don't know if it's a psychological thing. I don't know if it really matters at this point. The difference between 0% and -1% or whatever, I don't know if it would really matter at this point. They've got a lot of tools, and the Fed has certainly had a big psychological impact on the market. But I'm not sure the market would really care that much. It would obviously hurt your savings account a little bit, but I don't think the market would really care all that much, because I think rates are already on the floor as it is.
Yeah, I tend to agree with you. Makes stocks look more attractive too, right?
Yeah.
Cal McNeil, when should bear market stocks be considered aggressively? This is probably a lot of what we've been seeing in the marketplace with the cruise lines and the airlines.
Yeah. So it typically happens where when a bear market starts, you'll probably have the high quality stocks do really well when stocks are falling, and then the low quality junk stocks will get hit the most. And then when the bull market rallies, we see these junk stock rallies or low quality rallies, where those stocks that got hit the hardest, if it looks like they're not going to go out of business, they'll see a huge rally. And that's what we've seen in recent months and in weeks. But obviously the problem there is trying to time the bottom and pick when that's going to happen is much easier said than done. And now that we've already seen this big thrust higher, the question is, does it keep going, or do we peter out a little? And so that's what makes it tricky, is you just don't know how far these things are going to go.
Can you, Joshua Chappell, can you talk about why, in your example slide, REITs seem to perform very well in both 2000 through 2010, the last decade, and 2010 through 2020? That really stuck out to me, he says.
Yeah, good question. I mean, sometimes it's just luck of the draw, where it could be just the points you chose, because obviously during the 2006, 2007, when the real estate market blew up, REITs got hammered and they fell close to 70%. They had done so well before then, and after the crisis that they recovered. And REITs are an income producing asset. So the fact that interest rates have been falling has made them more attractive to investors. So it was more of what was happening in the market dynamics for that period that they did well through both decades. And obviously those two lost decade slides I showed, not always the norm where you have just a really bad decade followed by a really great decade. It could be somewhere in the middle, and REITs having two good decades in a row has happened in other asset classes too. I guess it just depends on which decade you're looking at.
Yep, timing is everything, I guess.
Yep.
Andrew Cam Watt, what about tax advantages and disadvantages between ETFs versus mutual funds?
Right. If you're holding your money in a taxable account, it really depends. If your ETFs give you a little bit better tax treatment, as long as you're not trading in and out of them. If it is an index mutual fund, you probably don't have to worry about that too much, but that's certainly something to think about depending on if you're having this in a 401k or a brokerage account. That makes sense that ETFs have bigger tax advantages than mutual funds.
Right. Okay. And last question from Julia Asante. Please, could you explain valuation and how it's calculated?
Sure. There's a number of ways. Any sort of fundamental you can think of, earnings, book value, sales, growth rates, any of these things. So unfortunately, there's not one really fundamental you can look at. It's a bunch of them. And so not really easy, but if there was a simple way to calculate valuations, maybe the market would be easier, but there's a million different ways to do it.
All right, Ben, thank you so much for your time today. We really appreciated your presentation. We had great questions from the viewers, and keep it up, guys. Keep the chat going. You're being very conversational. We love it. You could follow Ben on Twitter at what is your Twitter handle, Ben?
Oh, it's at a wealth of CS, and then just a wealthofcommonsense.com is my blog.